The NASDAQ 100 has been crushing it since the start of 2023 with over 70% return in a very short time span. However, what if you, as a European, could more than triple that and get almost 300%? This is what we will talk about in this video. Hi, my name is Ognian Stanoev, and after achieving financial freedom, I created this channel to help other investors who are on the same path. My core portfolio and investment thesis are centered around investments that pay you cash flow, which allows you to live life on your own terms. However, the investment universe is vast and multiple styles of investing and investment vehicles can be incorporated within a person's portfolio. Since I don't like to be religious on the topic, I will now talk about an instrument that should not be a core holding, representing the majority of the portfolio of anyone, but nonetheless is a viable, aggressive strategy for building wealth faster. And that is leveraging the returns of one of the best performing ETFs in the past decades, strictly for Europeans. We'll talk about the WisdomTree NASDAQ 100 3x Daily Leveraged Fund, which I will call QQQ3 based on its ticker, because I will get my mouth dried pretty fast if I have to say the full name all the time. Now, if you live outside of the EU and you want exposure to leverage ETFs on the NASDAQ, you can do that using the ProShares Ultra Pro QQQ ETF. However, people from the European Union cannot buy USA ETFs, and so now I will take a look at its closest equivalent in the EU. The WisdomTree Fund aims to track the NASDAQ 100 index and, using leverage and different financial instruments, deliver 3 times the daily return. What is very important to understand is that QQQ3 invests in financial instruments which should deliver the desired 3x return of the NASDAQ 100. This doesn't mean that the fund will hold the exact same stocks the NASDAQ 100 holds. That's not the goal. If you want to purchase the underlying assets in the index because you believe in the big tech companies in it and want exposure to them, you're better off by just buying the standard NASDAQ 100 ETF. QQQ3 uses swaps to replicate the performance of the index synthetically, which is a bunch of fancy words, but it basically means it achieves the returns by having contracts with different counterparties, not buying the stocks physically. So no Nvidia or Amazon or Microsoft shares for you, sorry. Also, although it is referred to as an ETF, it technically is an ETN, which means Exchange Traded Note. For the people who want to get more into the details of this terminology, you can pause and read this explanation provided by ETF.com. However, since this first wouldn't be a core holding in my portfolio, second, it is a fund that is regulated inside the EU, and third, has more than a decade of history, I wouldn't worry about that. After all, the idea here is to magnify the returns on an investment thesis you already have and hold it for a certain period of time in order to realize a good profit. It isn't to hold this as the core of your portfolio with which you retire and pass on to your children. But before I continue with the fund, let's take a step back. What is a leveraged ETF? The term leverage in finance comes from the use of leverage in the real world. Just like if you use leverage, you can lift heavier objects than you usually would be able to. When you use debt for your investments, you will be able to achieve higher returns than you normally would be able to. Consider this. If you have an asset that is worth $100 and you buy it with $50 of your own money, but the other $50 are taken as debt, you have the following situation. Let's say the interest on your debt is 5% and the asset goes up by 20% to $120. Well, in that case, your asset will be $120. When you pay back your debt with the interest, you will return to the lender $55, which leaves you with $65. This means that you made a profit of $15. $15 is 30% of the original $50 you started with, which is a 50% bigger return than if you had just bought the asset with $100 of your own money, because then you would have made 20% when it goes up to $120. This is essentially how this works with every leveraged product. As long as the conditions are good and the assets are growing more than it costs to borrow the money, everything is sunshine and rainbows until it isn't. Because in our previous example, if the asset doesn't go up but down 20%, basically from 100 to 80, then what happens is you still owe 55 to the lender. That leaves you with $25 from your original 50 you put from your own money, which is 50% loss. However, if you had bought the asset with your money entirely, then you would have only lost the 20%. So now, armed with that knowledge, let's explore the QQQ3 ETF. The fund has a decent size, at least for the European market, of 239 million euros at the time of recording. It is accumulating, which means that it reinvests all the dividends it receives inside the fund instead of distributing them to you. Bearing in mind that you will be buying this ETF mainly for either short to mid-term trading or taking advantage of the NASDAQ 100 price going up in the very long term, this is fine for me. The NASDAQ index isn't famous for its dividends anyway, and even the main ETF that follows it pays less than 0.5%, so that's not the main factor here. The total expense ratio is pretty high at 0.75%, but this is completely normal because this is a leveraged fund and it requires more active management than your standard ETF. Let's go to the most interesting part, the performance. Here on the left, you can see the current QQQ3 performance compared to the standard Invesco NASDAQ 100 European ETF, ticker symbol EQQQ. You can see the clear pattern here, which can only be described by the fact that QQQ3 gives you the NASDAQ 100 on steroids. Basically, when it goes up more. But when it drops like a rock, as you can see the case was in the bear market of 2022. You can obviously see the advantage of having such a leveraged product in a sustained bull market when the NASDAQ keeps going up, as it has for the better part of the last 2 decades. Now, unfortunately, I have not bought this fund years ago and I did not enjoy these gains, but if you want to see which are my top 4 stocks and ETFs for the current economic and geopolitical environment we are in, then go to the link in the description and I will send it to your email address for free. The report will always be up to date regardless of when you are watching this because I am constantly updating it. Alright, so if the QQQ3 is such an awesome ETF, what's the catch? Well, as you already saw, the fund is extremely volatile due to its leverage and you can easily lose 80 or 90% of it during a downturn. The reason why QQQ3 is up so much more than the normal NASDAQ 100 is the same reason why in bear markets it gets destroyed. And even if we get into a sideways market, you are going to be screwed by the high expense ratio, which will be eating 0.75% of your capital every year. Now, if you're a more observant person, you have probably noticed that whether in bull or in bear markets, the QQQ3 results are never exactly 3 times the results of the NASDAQ 100. This is because the goal of the WisdomTree fund is to 3x the result of the NASDAQ 100 within a single day. Because of that, long term, there is a big mathematical deviation from the 3x mark. In order to understand why that is, we have to visualize it with a little bit of math. To make it simpler, I will do it with doubling, not tripling the results. Here's a hypothetical example. Let's say that on day 1, an index starts with value of 100 and a leveraged ETF that seeks to double the return of the index starts at 100. If the index drops by 10 points on day 1, it has a 10% loss and a resulting value of 90. Assuming it achieved its stated objective, the leveraged ETF would therefore drop 20% on that day and have an ending value of $80. On day 2, if the index rises 10%, the index value increases to 99. For the ETF, its value for day 2 would rise by 20%, which means the ETF would have a value of $96. On both days, the leveraged ETF did exactly what it was supposed to do. It produced daily returns that were 2 times the daily index returns. But let's look at the results over the 2-day period. The index lost 1% because it fell from 100 to 99. The ETF fell from 100 to $96. That means that over the 2-day period, the ETF's negative return was 4%, which is 4 times that of the index it follows, instead of 2 times the return. You can see how that daily goal results in a vastly different result over the long term. This is especially multiplied by the fact that the QQQ3 ETF aims to deliver not 2x, but 3x the return of NASDAQ 100. So why is that such a risk, you may ask? Well, let's see what happened in the past few years. After the sharp drop in price we already talked about in 2022, the NASDAQ 100 ETF has recovered and is already at all-time highs. However, the QQQ3 ETF is yet to touch its highest point, which it reached at the end of 2021. This is because of simple math. When an investment drops with large amounts, it requires an even larger amount in percentage terms in order for it to recover to the previous point where it dropped from. If an investment goes down from $100 to $50, this is a 50% drop. And in order for that investment to recover to its previous $100 point, it now has to go up by 100%, because 50 has to double in order to become 100 again. And the bigger the numbers get, the more extreme the recovery has to be. For example, if an investment drops from 200 to 50, this is a 75% drop. And in order for it to go back to 200, it now has to experience a 300% increase. So by looking at this, you can now understand why a sharp, violent bear market can wipe out the majority of the value of a leveraged ETF like QQQ3 and then make the fund lag the original index it is tracking for years and years ahead. This, combined with the fact that you have absolutely no visibility over what the returns are going to be in the long run because of the daily target we already talked about, makes the QQQ3 ETF a highly volatile and unpredictable investment. This is especially true when it comes to one-day sharp market crashes. If the NASDAQ 100 drops with more than 33% in one day, since the goal of the leveraged ETF is to triple that, this means it will lose 100% of the value, which is game over. Now, what is the likelihood of a 33% NASDAQ crash in a day? Well, pretty low. Let's start with the fact that it has never happened. The largest drop in the NASDAQ index came on March 16, 2020, during the COVID crash, and it was around 12%. So the odds of a 34% drop within a day are not zero, but are pretty low. And by the way, if anything like that happened, the markets will probably be stopped. This is called circuit breaker. If the S&P 500 falls with more than 20% within one trading day, all markets in the USA will be stopped for the remainder of the day, as we can see here on Nasdaq's website. Now, since the QQQ is more volatile than the S&P, you can assume it will fall more than 20%. But in my opinion, a 34% drop in a day before the 20% in the S&P 500 has materialized and the market is stopped is highly unlikely. I mean, a global pandemic that no one knew if it would kill most of us couldn't drop it with more than 12%. So I guess unless a nuclear exchange is made or an asteroid hits the Earth, it is very unlikely. And if any of those things happen, well, it really doesn't matter what you have in your portfolio, so there is no reason to discuss it. However, as I said, the chance is not zero, and the added leverage makes the QQQ3 ETF extremely volatile and at risk of getting completely wiped out. This is the major reason why I think this should never be a core holding in your portfolio and the thing that you are betting your retirement on. If you want to learn more about what types of investments I like for the goals of achieving stable and predictable passive income that will give you financial freedom and allow you to retire either earlier or with additional money when you reach your retirement age, then I invite you to join my free investing masterclass, for which you can find the link in the description. Alright, so what is my final verdict on the ETF and how would I use it? Of course, you have to remember that I cannot give you advice on how you should use it. I'm just sharing my thoughts here. In my opinion, the QQQ3 ETF is great for two types of people. The first type is a more active investor, who I would personally even call more of a trader, who goes in and out of markets frequently and does some technical analysis, as well as tries to predict the market movements on a weekly or monthly basis. If you're the type of person who can accurately predict when the markets are going to crash and avoid those horrific 80 or even 90% drawdowns in the ETF, then you will probably do fantastic with it. The second type is the very long-term technology optimist investor, who believes these types of companies will continue their relentless march upwards in the next years. For that type of person, who is also able to stomach the extreme volatility of a 3x leveraged NASDAQ 100 ETF, this might be a good bet that amplifies the returns they would already expect based on their thesis from the QQQ. Also, in my opinion, the best ways to invest in such volatile high-risk products is when you literally separate them in different buckets from your main portfolio. Now, when people hear that, they think I am talking about separating their brokerage accounts or using only a fraction of their main portfolio. And all those things are true, but this is not the main point. By the way, when I mentioned separate accounts, you probably need to request a product like this leveraged ETF in your brokerage account, because you might not be able to buy it with the permissions you already have. Different brokerages have different requirements, and it is entirely possible that when you created your account, you are asked what type of an investor you are. If you chose a more conservative approach, you might have to retake some investment quiz to prove that you have the knowledge to invest in leveraged products and that it aligns with your goal. However, that aside, what I mean by separating these investments into different buckets is different mental buckets. I'll give you my situation as an example, and then you can draw conclusions for yourself. When I invest in high-risk products like this, I'm not only conservative with the amount that I do it with, but I'm also not psychologically and emotionally that invested in them. This is because I have built different layers of financial security, and I have different expectations for all of the assets I own. For example, I own my home and my car, and I don't have any debt that I have to worry about. I have an emergency fund that can cover more than 12 months of my and my family's expenses. So these are the base buckets for me. This is the basic security that I have for me and my loved ones that prevents me from going into an immediate disaster. Then, most of my investments are into dividend-paying stocks and ETFs and rental properties from which I collect passive income. This is the third bucket, and the goal of it is to allow me to never have to worry about whether my family can pay the bills, get groceries, or put fuel in the car, regardless of whether we are unemployed or my business is not going well. And then I have a fourth bucket, which is for the higher risk investments. This bucket is where I would put something like a leveraged ETF, like the one we just discussed. Now, the goal of these buckets is not just to keep them separate within your account, but as I said, to keep them mentally separate. If any of the first three buckets disappears or goes down in value significantly, I will be very, very worried. So if I suddenly have to sell the place I live in, or my emergency fund disappears, or all my dividend stocks cut their dividends with 15%, that would cause me an immense amount of stress. However, if my 3x leveraged NASDAQ ETF goes down 80% like it did in 2022, it probably wouldn't even register with me on an emotional level. This gives me the advantage of being able to weather those horrific downturns and not panic, which would then allow me to reap the benefits of the next long-term bull market. Now, you might be listening to this and being like, but Ognan, I don't have a home without debt or dividend stocks paying my bills. And I understand, and that's fine. That's not the point. The point is not to have absolute security before you do risky stuff, which, by the way, I also don't feel like I have. The point is to be able to mentally regulate your behavior. This is just a useful trick that I have found works for me, and I'm sharing it with you. If you're finding this valuable, then like this video, subscribe to the channel for more lessons like this, and check out this video that should have appeared on your screen already in order to continue with your investing education. Because one of the things that will allow you to use riskier strategies is the knowledge that you have for them, which will create the conviction that will allow you to ride out the inevitable market downturns. Knowledge equals conviction, and conviction equals mental clarity.